Hello, everybody, and welcome back to this month's webinar, Three Major Risk Categories in Retirement. We're really happy to have everybody here. We had some technical difficulties trying to record this webinar a couple weeks ago, so this is a re-recording, just so anyone who was not able to attend the session is able to watch it now. So again, thank you very much, everyone who was able to attend. And hopefully everyone finds this webinar as interesting as the previous webinar. So we'll dive right in. First, let's go through a couple disclosure items. One is obviously who 4J Wealth is. We're a registered investment advisor. The content of these webinars is always for informational purposes only. It's not intended to be advice. To the extent we mention any performance figures, that's not any guarantee of future returns or any prediction of future returns. Any securities mentioned in this webinar do not constitute a solicitation to buy or sell. Investing always involves risk and possible loss of principal. No advice may be rendered by 4J Wealth unless a client service agreement is in place. So the three major risk categories for retirees are: number one, planning for a longer life. Right? The idea that what used to kill us is now disabling us. People are living much longer, which requires a lot more resources. And we hope that those extra years are in good health, but that's not always the case. Number two is market risk, right? The uncertainty around returns that you're going to have in your portfolio. Are they going to be positive at the beginning of retirement? Are they going to be negative at the beginning of retirement? Nobody knows. And historical averages don't really matter, because what matters is the return in the year that you actually retire. And then number three are spending shocks. We're all aware to some extent of the ongoing expenses that we have in order to meet day-to-day living expenses. But there's always expenses that creep up that are unexpected. It could be a healthcare event. It could be the need for a new car. It could be a long-term care event. It could be, changes in your personal circumstances that result in a higher level of spending than you had planned for. So let's first kind of take a step back and talk about the meaning of risk in retirement, because risk, as defined by the financial media, the financial industry, is almost always related to market volatility, right? That the volatility you see in your portfolio on a day-to-day or month-to-month basis that can cause a lot of unrest and anxiety, but is very different from the type of risk we're talking about when we're dealing with retirement risk, right? Market volatility is usually associated with the accumulation phase of one's life. Retirement income risk, right? The risk you deal with to your retirement income once you're no longer working, really deals with the risks that pose a permanent threat to one's standard of living, okay? And retirees have to decide how much risk to their lifestyle they're willing to accept. And that's very different from the volatility or the paper losses they're willing to accept in their portfolio along the path to retirement during that accumulation phase. So for retirees, their capacity to endure risk, as we define it here for a retiree, is a very critical input. And what risk capacity means is it's how much of a portfolio loss can be endured or suffered without impairing one's standard of living, right? If you are still 15 years out from retirement and we go through a 2008 type of market, that would be very traumatic. But if your portfolio went down 50%, you don't need to spend from that portfolio in that year. You can afford to let it ride. And as long as it's come back within the next few years, and you still have years to go for retirement, in many circumstances, you're going to be okay. That's a very different situation from someone who retires and their portfolio is down 50% and they have to pull income from that portfolio. It's extremely difficult to ever get back to that starting point. And so that's the type of risk we're talking about, is that permanent loss of capital, which permanently impairs your standard of living on an ongoing basis. So life expectancy, I think, we talked about the three categories. Planning for a longer life. We don't know how long we're going to live, right? So life expectancy is one of those variables that is really hard to plan for, because we may live 1 year in retirement, God forbid, or we may live 40 years in retirement and have everything may go, you may be in wonderful health the whole time, or it could be somewhere in between. So how long your retirement plan needs to generate income, right? That's kind of the central question to making sure that you have a plan where you're not going to outlive your money. Length of retirement could be shorter or longer than your statistical life expectancy. And don't forget that the death of one spouse can result in pension or Social Security income loss, a change in tax rates, right? Because you go from married filing jointly to single, less advantageous tax rates. And it can also present estate planning challenges, because depending on how the estate planning was conducted, if it's not thoughtful, and those documents and the plans weren't in place, and one spouse passes, the assets are going to go to where they go at that point. And that deceased spouse can no longer undo what their estate plan was, what the estate plan intended to do. So life expectancies, as we know, continue to increase as science discovers new ways to prolong life. And longer lives can be wonderful, but they do lead to costlier lives and a bigger drain on resources. And I think it's important to note, for many retirees, if you're really scared about outliving your money, you're not alone. Fear of outliving their resources can exceed the fear of death for some people. So this is a real issue that needs intentional planning to deal with it. So what is longevity risk aversion, right? I mentioned longevity risk, and then there's the aversion to longevity risk. So think of it as the emotions related to how one feels about the possibility of outliving one's retirement assets. A very high longevity risk aversion would mean that you don't really want to take chances. You want to plan to live maybe to age 100 or even a little bit beyond 100, because you don't want to have any shadow of a doubt that the money is going to be there when you need it, right? So the higher the level of aversion, the higher or the bigger the planning age that you need to plan for. And then a concept that we talk a lot about in the planning meetings that it's important for you to understand is the idea of front loading versus back loading your income preference. Some clients, when they retire, understand that the money may need to last 20, 30, 40 years, but they also realize that they're in this indefinite, or finite period of time where they're going to be mobile enough and healthy enough to do the things that they really want to do, such as travel. And so they want to make sure that they enjoy those things that they've always wanted to do in retirement but haven't yet done yet, such as travel, early on in retirement. Well, that means they're probably going to spend more kind of on the front end retirement, and accept that means they may need to make cuts later on, right? Ideally, that they know this going in. Conversely, someone with a really high longevity risk aversion might say, well, yeah, I do want to do that travel and things, but I'm more concerned about making sure when I get into my 80s and 90s that, I don't have to rely on my kids to help me pay for assisted living or nursing home like I had to do with my parents. So I'd rather do less travel, or travel every other year, right? Really kind of budget out my travel versus doing it all up front, so that I'm not overspending early in retirement, right? And that's not necessarily right or wrong. That's just a preference, and you want to be aware of it so you can balance it. And so one of the key questions to ask yourself is, what level of spending are you willing to accept today to plan for a longer life and ensure you will not deplete your assets before death? Again, on the subject of longevity and retirement, right? Average life expectancy, anybody can look that up, what a life expectancy is based on your age, your gender, whether you're a smoker or not, and you'll get a number. And that number is a midpoint. It's not an endpoint. And a lot of people think of life expectancy in terms of the numbers at birth, right? Looking at, okay, well, what's the life expectancy for someone being born today or someone who was born in 1950 or 1960? What you really want to look at is, what's the life expectancy for someone who's already made it to your current age, right? So if you're retiring at 65, you want to know the life expectancy for someone who has already survived to 65, because that's going to be longer than for someone who's 30 today. And just be aware and cognizant that your plan probably needs to last longer than you might think. Most people don't think of life expectancy in a joint fashion where they're thinking about them and their spouse. But when it comes to retirement plan, that's exactly what you need to do. There is a greater chance than you might expect. In fact, there's a 21% chance that either you or your spouse will make it to age 95, right? If you both already made it to age 65. And as you can see from this JP Morgan chart, if you're both in excellent health and non-smokers and have made it there, there's almost a 1 in 2 chance that one of you will make it to age 95. So, right, even if your life expectancy is 87 or 89, you have to look at it from a joint perspective, and you have to account for the fact that you've already made it to age 65, for example, and so your life expectancy is probably going to be longer than if you're just looking at a templated life expectancy table. So how do you choose that planning age? Well, obviously it's going to vary for every person, but we can give you some guidelines. Obviously, you want to think about your personal family history in combination with, general statistical life expectancy data to optimize your plan, right? Did your parents live into their 90s? If one of them died prematurely, was it because of a habit like smoking, or something like that that may have caused them to die earlier, and that wouldn't necessarily apply to you? An interesting tool that you can look at is longevityillustrated.org, which asks you some questions to get a more precise estimate of what your longevity might be. So you want to kind of think about all these factors, and then combine them with your subjective level of longevity risk aversion, right? A good example is if you are concerned about outliving your money, so you have a high level of longevity risk aversion, you're going to want to use a planning age that corresponds with a low chance of survival at that given age, right? Because you want to say, okay, well, if there's only a 1 in 10 chance that either my spouse or I make it to age 97, I'm comfortable with that. But there's a 50-50 chance I want to go further out. And so you can see here, for couples who've made it to 65, they're non-smokers, and they want to kind of be, I would say, if they're more of a front-loading preference, they might be able to look at the 92 to 98 range in terms of life expectancy. But if they're really risk averse, they probably want to take the plan to age 100 just to make sure they have a built-in margin of safety that their money's going to make it all the way. So the second big risk to retirees, as I mentioned, is market risk, or more specifically, something called sequence of return risk. Most people, when they think about market returns, they think about it in terms of what the average returns have been. So if you said, okay, well, if we go back from 1926 and look at all the returns to the end of 2020, what would the compounded annualized rate of return be over that time period in large US stocks? And the answer would be 10.3% compounded annualized return, which is fantastic. But that's an average. That's an average, right? Very few years did the market actually return that return. Some years it was much higher, some years it was much lower, some years it was very negative. And so the average return is great from a long-term planning standpoint, but it's not great in terms of assuming that's what you're going to get in or around retirement. And again, the price that you pay for that really high compounded return is portfolio volatility, right? I mean, in order to get that return, you would have had to sit through some horrific downturns in the market, sometimes multiple years in a row, like during 2000 to 2002, before the market resumed its upward trend. And so that volatility, while you're accumulating money, as long as you can stomach it, doesn't really impact you. But as soon as you start to need to rely on that money to generate income for you in retirement, those volatility of return absolutely poses a risk to retirees. So what you want to start with, I think, from a retirement planning standpoint, is assume a lower rate of return on your investments in retirement, because the lower that assumed rate is, assuming the plan works, in that modeling scenario, the more likely it is that your plan's going to succeed in real life, right? Because you've built in a margin of safety. And you just need to be aware that a period of poor market returns early in retirement represents a real risk to retirees and needs to be planned for. right? So you want to stress test the plan before you retire, looking at a series of poor market returns early in retirement and see whether the plan is able to sustain itself. And this can be done using software. So again, the idea here is we never, there's always going to be risks that you don't foresee. There's going to be things that happen that you don't expect. And that's why we want to build in a margin of safety, because we don't know exactly what's going to happen. We want to make assumptions that assume a lower than average rate of return, poor market returns when you get into retirement, so that if the plan works under those circumstances, then you can feel a lot more confident if they do in fact play out. Say, yes, we knew this was a possibility, we had planned for it, and so we feel less anxiety over what's happening in the world today and what's happening in our portfolio. So within market risk, I want to talk about risks and benefits of fixed income assets in retirement. So a lot of people think of fixed income assets as, well, it's not in the stock market and so it's safe. And that's not completely accurate, right? And a great example of that is in 2022. The Barclays Aggregate Bond Index was actually down 13%, not because bonds were defaulting. It was purely a function of how fast interest rates rose during 2022. And it was actually the worst year for bonds going back 100 years, if you can believe that. So 2022 was just a real anomaly because stocks went down double digits and bonds went down double digits. So unless you had a lot of money in commodities or energy, or basically were a non-diversified investor, which is not advisable, there was nowhere to hide. And the volatility around bond returns is directly related to changes in interest rates. You can think of it like a seesaw, right? As interest rates rise, bond prices are going to decline. When interest rates fall, bond prices increase, right? And so that inverse relationship is really important to understand. And it can be a benefit, right? It can be something that can help offset equity losses, because if rates are declining, it could be because there's a recession, and so people are actually fleeing from stocks and going to bonds, which is lowering the yield and increasing the price. But as we saw last year, that doesn't always happen. Another thing you remember is the longer the maturity of bonds, right? The longer the bond goes until you get your money back, the more sensitive those types of bonds are going to be to changes in rates. One way to kind of help mitigate some of this risk is to use bonds or bond funds with targeted maturities, right? And so that if you own a bond or a bond fund where it matures in a particular year, then you're going to get all of that money back in that year, and that can be used to fund your retirement expenses for that year. And you can actually ladder those bonds out to go out, 3 years, 5 years, 7 years, 10 years. Now, you don't want to just do it blindly. You want to do it intelligently. I remember I was talking to a prospective client back in 2020 after the pandemic had hit and rates were at zero, and he wanted to lock in a 10-year ladder bond at very, very low rates. And I said, look, you may want to wait for the dust to settle to see kind of what happens as we move through the pandemic and how policy normalizes, because you're basically going to be locking in 10 years of bonds at less than 1%. Right. So it depends on the environment as well, but this is a viable strategy to help manage, for example, that sequence of return risks, right? Because if you have enough in bonds with laddered maturities and very high credit quality for a 5 to 7 year period, well, that gives you some time where you don't have to worry if the market's down 1 or 2 years, because you know that you can fund your expenses for 5 to 7 years. In addition, bonds do generate, most bonds, income, right? They pay out an interest on a semi-annual, sometimes more, basis. It's contractual, and so it's more reliable and stable than dividends from stocks, which are not contractual, right? That's up to management as to whether they pay a dividend and how much the dividend's going to be, and that dividend can be cut, as it was for many energy stocks back in 2016 when the price of oil dropped. So let's move over to stocks, right? There's risks to stocks, there's benefits to stocks, and we're talking specifically in retirement. Over the long term, right? And people say stocks for the long run, and there's a lot of truth to that. Stocks have done a very good job of compounding wealth, even after accounting for inflation. Stocks have outpaced inflation by 7.2% per year on average, which again is an important, plays a very important role in the retirement portfolio because you're going to need money, beyond year 15, and you have to have some money in your portfolio that's outpacing inflation to help pay for expenses in that back half of retirement. There's obviously going to be a lack of predictability of stock returns, and the volatility of returns has an asymmetric effect on wealth, right? If your account drops by 10%, you need like 12% to get back to the starting point. If it drops by 50%, you need 100% return to get back to your starting base. So naturally in retirement, for most people, you should be more conservative. And from 2010 to 2020, it was really hard to be conservative because you couldn't get any return in bonds because the interest rates were so low. And so basically you're holding any money you're holding in bonds wasn't really even keeping pace with inflation. The good news for investors was that stocks went up basically every year. But that all turned in 2022 and stocks and bonds went down. The silver lining is now finally, after 10 plus years, we can get a return on fixed income, which allows us to have a higher allocation of bonds and actually get a return from that allocation. For people who are, within 1 to 2 years of retirement, we don't want to think about the returns in stocks based on their historical averages. Why? Because the historical averages only matter in the long run. They don't matter on a year-by-year basis in retirement. And you're particularly vulnerable early in retirement to a dropping portfolio and pulling money out of that portfolio for your spending purposes, right? So early portfolio losses disproportionately impact your lifetime sustainable spending rate. The other thing is, right, you don't want to rely on long-term historical returns from stocks when planning your retirement income strategy, right? Because it's going to expose you to risk of depleting your portfolio prematurely. If you're assuming you're going to get an 8% or 7%, or I think even 6% return, on average in retirement, and that's what you bake into your plan, it's not going to be that hard for that plan to kind of unravel if you have a couple tough years early on in retirement. So again, this concept of building in a margin of safety, no financial planner can model every possible risk that's going to happen, right? Nobody can foresee the future. But the way that, someone like, in the engineering industry, right, the way they handle these types of things is, well, if I know I need a bridge that can handle 100 cars going on at any given time, I'm going to build that bridge where it can handle the weight of 200 cars, right? And that's kind of that margin of safety that they build in to ensure that whatever you're building can withstand unforeseen circumstances. It's the exact same thing with your retirement plan and your retirement planning. So I mentioned sequence of return risk before, and I think this is probably the best example that highlights that the average return in retirement matters less than when the returns occur relative to your retirement date. So your retirement risk is highest in that first year of retirement, as you'll see from when I go through this chart. And you need to remember that returning to work may not be easy after you retire, right? For a number of factors. Could be the economy's weak. Could just be that, they can hire someone a lot less expensive than a 65-year-old, whose maybe skills are becoming outdated and that they can't invest in over the long run. So this is the exact same starting value, exact same age, and the same annual withdrawal amount for this portfolio. They're taking out $25,000 every year, just for illustrative purposes. The only difference between these two examples are on the left side, you'll see that the returns are negative at the start of retirement and then gradually become better. And then On the right side, the returns are positive early in retirement and then are negative at the end. In fact, the returns are mirror images of one another, right? So the last year of retirement, the last year here of a negative 10% return is the first year of retirement in this example. And the last year here becomes the first year here. And the point of this is to illustrate that everything else being constant, even with the same average annual return, when you have a period of negative returns, and this was really bad, this was like 2000, 2001, 2002, and this is what U.S. stocks did during that time frame. If you have a period of negative returns early on in retirement, it basically is not recoverable, right? They essentially run out of money after 18 years. Whereas here, they have positive returns early in retirement, even though they have some black eyes later on at age 75, and then kind of in their early 80s, is a totally different picture. Right? They have $500,000 after 18 years, basically where they started. Whereas in this example, because of negative returns during retirement, they're basically have exhausted all of their assets. So a lot of people not mistake, but the behavioral or emotional side of human beings can really make this challenging, because the last thing people want to do is retire after they've had 1 to 3 years of poor market returns. But the truth is that a lot of times retiring after a really rough period of the market, even though psychologically it doesn't feel right, can actually be the right time to retire, all else equal, because it means that there's a reasonable chance of reversion to the mean, and stocks are actually going to do better going forward. Whereas if you retire after a decade-long period of really good returns, like 2010 to 2021, then you get hit with something like a 2022. Not always, but that's what happened, right? The 90s were a fantastic year for stocks, and then early 2000s were really rough. 2000, 2010, stocks were flat. Who would want to retire in 2010? Turned out that was a great time to retire, even right after 2008. So it's a tough one psychologically to actually manage through, because it goes against everything you're feeling in that moment, right? The economy's not doing well, the market's not doing well, and now's a good time to retire. Well, you have to think of it. You really want to think of it as, even though the market's had poor returns, what we need to think about is, in the future, is there a decent chance returns can be better? And therefore, okay, I can get myself comfortable with letting go of work. One way to mitigate the sequence of return risk, and I kind of mentioned this before, is the time segmentation, or the bucket approach, we call it, where you keep your short-term goals, right, your emergency reserve, in just cash. And then between years 1 and 10, your medium-term goals, those are mostly in bonds, maybe a little bit in equities. And then your longer-term goals, kind of what's 10, 15 years out, that you have predominantly in equities, with the idea that that's money you're not going to touch for 15 years or more. And even though the returns of that portion of the portfolio could be negative early in retirement, is going to be more volatile, it has the best chance of outpacing inflation and being there for you to meet your expenses when you get to that stage of retirement. Number 3, major risk category: spending shocks. So what is our spending shocks? It's the risk that your planned expenses, right, what you anticipate to spend, will be greatly exceeded unexpectedly and involuntarily. Probably the biggest example of this, of a spending shock, is paying for long-term care, right? It's related, right? The care can be related to a mental thing. It can be a social impact. It can be wrapped up in medical needs. But it's when you're unable to take care of yourself, it creates a logistical challenge, because there's a monetary component, because Medicare is not going to cover the majority of long-term care expenses. It tends to be very expensive. And there's the logistical and emotional component. Where are you going to get the care? who's going to give you the care, right? It may be your plan that you think your children are going to provide that care, and maybe they are able to do that. But we've seen in our business that that's not always a possibility, because your kids have their own lives with their own families and their own jobs, and they're not able to just drop that to come care for you. So this is something that needs a lot of attention as part of your retirement planning, and you need to decide how you're going to address this. Maybe you have enough money and you're prepared to self-insure, right? You're gonna pay for the costs out of your portfolio when and if these costs arise. It's the highest risk approach, right? But for people who have enough resources, they may be comfortable with that. Another option is to purchase some sort of insurance to create a pool of assets where if this event happens where you need long-term care, you're able to tap into those pool of assets to draw on them precisely to pay for the care that you or your spouse needs, okay? There are other planning approaches that can be used, such as, well, we live in this house, but in 10 years, we're going to be selling this house and downsizing or moving into some sort of adult community where they have those services available to us. Goodwin House is an example in the Arlington, Alexandria area of a facility where you can actually move in and have independent living, but then gradually, kind of as your situation evolves, the services are all there available to you to address those needs. Another spending shock can be higher than expected inflation, right? Inflation is one of those things that you don't necessarily feel on a day-to-day, month-to-month basis, sometimes even year-to-year, but over time it has a really profound impact. And the simplest definition of inflation is it's an erosion of your purchasing power, right? What you're able to buy over time. So you need to include a reasonable inflation rate on spending throughout retirement. You want to consider using inflation hedges like TIPS or Treasury inflation protected securities. I-bonds are fairly popular right now in a way to help hedge inflation risk. And then equities, as I mentioned before, over the long term, because of their growth potential, have a reasonable chance of outpacing inflation. And then another thing you can keep in mind, another way to exercise margin of safety, is to keep a higher cash balance, especially early in retirement, where if there is an inflation shock, right, you're able to handle that with an increased cash balance where you don't have to sell from your portfolio to meet those higher expenses. Another spending shock, death of a spouse. Okay, this is a big one because it's always going to reduce your Social Security income because you only get to keep the higher of the two Social Securities. If there's pension income from the federal government, from the military, from a private corporation, usually that pension income is reduced by half, potentially more. Your taxes often can increase as a result of moving from a married filing jointly to a filing single. And then the other thing is just the risk of handling family finances after the money spouse passes away, right? The person who pays the bills, handles the taxes, manages the investments, maybe has a relationship with the advisor. A lot of people think, well, we don't have an advisor. We don't need a financial advisor, maybe because I manage all the money. And what they don't realize as part of that is that if something happens to them now, and these spouses have come to us, so we know how real this stress is. They come to us with a portfolio that their spouse had basically managed and created. That was something they understood and is not necessarily transferable to the spouse in terms of what their preferences are, what their risk tolerance is, and they don't know what to do, right? They have this money, but it's a source of anxiety because they don't know how much they can take from it, what the allocation means, why it's going up, why it's going down. And of course, this situation disproportionately affects women because women live longer than men. And still, I would say generally, in the generation that's retiring today, the male is more often kind of responsible or in charge for whatever reason of the financial house. Not always, but generally. So I would say this is a huge issue that is underrated and not enough attention is paid to it. The other spending shocks deal with things that are outside your control, but you still want to be aware of, like changes in tax rates and policy, right? You need to be aware that taxes on retirement income don't necessarily stay the same or go down over your retirement time horizon. It depends on what's happening with Congress, right? Who's in Congress, what's facing the country. There's also, potential changes to Social Security, how it's taxed. Medicare Part B, Medicare Part D premiums are going up. Changes to when you have to take money out of your IRAs or Roth IRAs, all sorts of possible changes. And so what that means from a planning standpoint is we want to have maximum flexibility. It may make sense, even if it doesn't make sense today in terms of the tax rules, to have money in a Roth account, just to have some diversification of where you can pull money from in retirement if you need it and not get hit with taxes, right? You pull from a Roth. Generally speaking, if you had that account open for 5 years and you're over 59 and a half, that money's not going to be subject to tax, right? Having a health savings account, things like that, where you can pull from it tax-free for medical expenses, having that flexibility is really, really important in retirement. So thinking about a path forward, right? The key to this, to what we're talking about today, is risk management. Risk management is an integral part of a successful retirement. We always want to err on the side of caution and not count on high or historical returns in retirement. We want to build in that margin of safety. We want to stress test the plan for spending shocks, like a long-term care event, a premature death, or even poor market returns, to make sure that the plan works most of the time in all those circumstances. We also want to account for the fact that you will need help as you age, cognitively and physically, right? Even the brightest minds, we've seen it with our own eyes, that as people age, they're not always as sharp as they were. They can forget things. And so having someone on the wheel, someone ideally who's kind of objective and can kind of look at things holistically, can provide advice to think things through, like who's going to handle the taxes, pay the bills, manage the portfolio if something happens to you or your spouse. Again, risk management, right? Thinking about unforeseen expenses down the road. A very easy way to help minimize or mitigate that is to delay the highest income earning spouse Social Security to age 70, so that you max out that inflation adjusted guaranteed income stream in retirement. I think another really important point is to, especially going into retirement, is know what your budget is, right? Know what your expenses are. What are your needs-based expenses, right? What do you have to spend, in order to live? And then what's discretionary, such as travel and entertainment. And as much as you can, you want to match your needs-based expenses with conservative investments or guaranteed income sources. And the discretionary expenses can be more mapped to, your higher risk investments, like a diversified stock portfolio, stock and bond portfolio. And then just know going in that the plan is not going to go exactly to plan. There's going to be surprises, right? Don't think that no matter how much planning you've done, that it means that things are going to go exactly as you think they are. They're not, right? Life is full of surprises, and we're trying to build a plan that's resilient and adaptable. The big plug for estate planning, ongoing estate planning, right? Some of the biggest risks we've talked about relate to incapacity or death of a loved one, right? So your team of professionals and family are an integral part of your retirement and your succession plan. Having a trust with contingent trustees, funding the trust properly, they provide a level of redundancy to ensure that your wishes are carried out as planned. Powers of attorney provide similar redundancies. And then having a team of planners, CPAs, attorneys can really help provide continuity during those turbulent periods for a family when somebody dies or becomes disabled. Money is changing hands from one generation to the next. So If you haven't gone through estate planning, it's a definite must, and something we'll be talking about more this year. If you have, you want to make sure that you revisit those plans, especially as you get closer to retirement. And something you wrote 30 years ago when the kids were in 10, 12, and 14 doesn't have any relevance once they're adults and your financial situation's evolved and you're now retired. So you need to revisit and update that plan to make sure it corresponds with the current situation and your current wishes. Thank you so much for joining me today and joining 4J Wealth. We look forward to having more of these webinars. If you have any questions, feel free to email us at info@4jwealth.com. I'm Josh Goulding, and until next time, have a great day.